welcome everybody and thank everyone here so much for taking the time to be here. We certainly don't take for granted that everybody here has very important things that are going on. And so whether it is that you're leaving work or leaving your family or your animals or whatever it is today, we really appreciate you taking the time to be with us. I haven't had the greatest pleasure of meeting everybody yet. My name is Kelly Conroy. I head up global education. I've been with the brand about 18 months now, and so it's all been in this COVID world. I really look forward to a world when I can come visit you in your salons very soon, but just a little bit about me. I've been a hairdresser for 20 years now, and I've worked in the professional education space for about 20 years now, and I couldn't be happier to have this position under Bumble and Bumble and really work on elevating all of you and what we do every day. So I'm just really honored to be here. And besides me, I'm joined with our teams today. If everyone from Bumble and Bumble wants to put up their screen or put an emoji wave or say hi in the comment section, this is the Bumble and Bumble team. And of course, we're here hosted with our infamous BB Live team, James Ruiz and Brittany Williams, who will be supporting us through the event today and helping navigate any questions and comments that could come up. As of course, we want to make sure that you guys get the most of your time. So on behalf of all of us from Bumble and Bumble, we want to welcome you to our second wellness series event. Today is going to be focused on the beauty of finance, something I know that I desperately need in my life on a daily basis. We've started these wellness programs. As I said, this is our second one. Wellness is really going to be a key pillar of our programs as we move forward in the Bumble and Bumble curriculum. We certainly want to have you know that it's top of mind for us to support you and your teams, your businesses, you personally, with all your education needs as we're still navigating this very dynamic environment that we've been in over the past 19 months and continue to keep navigating us through. But regardless, today, regardless of what you do for a living, and what your role is in the salon environment or in your family unit, that financial wellness is definitely a recurring theme that comes up in life over and over again. I know it does for me. As I said, constantly on a daily basis when I'm buying stuff on Amazon that I know I don't need, and Uber Eats because I'm too lazy to make myself food. Those are my two bad things that I do all the time. But I'll have to say I'm super, super excited that we've partnered with an incredible woman by the name of Anna Manukyan, who is the CEO of Beauty of Finance, to really help us elevate all of us in this topic of that's so relevant to us as humans and us as professionals as well too. I personally have had the honor of working with Anna in the professional education space for over 15 years now, I think, in a bunch of different capacities. She's someone that I've admired and looked up to and collaborated with. So it was really special for us to have her come under the Bumble umbrella. She's had a very impressive career starting out as a hairdresser and working as a hairdresser in executive leadership roles, with always a key focus of developing salons, developing artists, and developing our professional industry. And because of this, she's certainly seen firsthand the need that creatives have for accessible, user-friendly education on the topic of financial wellness. And she's dedicated almost 2 years now that I know, I might be telling her story wrong, to cultivating all of her energy into helping professionals build wealth through financial freedom. And so that's what today is going to be about. I really hope that you guys enjoy. We will be recording this session and putting it on our Facebook group as well too. I certainly encourage you guys to interact with us as much as possible, ask as many questions. Anna's a very incredible facilitator that I'm going to hand it over to her and you'll get to see firsthand for yourself. So over to you, Anna, and thank you so much for being with us today.
Thank you so much for that incredible introduction, Kelly. I could not be more excited to be here with all of you. And, it has been a really interesting journey to get here. Like Kelly said, I am well, before that, I would just like to thank all of you for being here. Like Kelly said, there is a lot that each one of you had to do in your personal lives to be here with us in this space and time. And so thank you for giving us the next 2 hours. Thank you for your attention. Thank you for the space that you're going to hold for us. So truly thankful for that. And for the incredible Bumble and Bumble team, just thank you so much for having me. I'm so looking forward to the collaboration. You guys are absolute rock stars, and thank you for setting me up for such incredible success and for really taking this content and really bringing it to life in your salons. I'm really thankful to be here. So hello, everyone. The world of finance does not have to be scary. I've been in the industry for over 2 decades, and it's always really funny to say like 20 years, 25 years. Time flies really quickly. And much of what we're going to be talking about today, there's probably going to be a couple of times where you're going to think to yourself, God, I wish I knew that when I was starting out. Oh my gosh, I wish I knew this 20 years ago, right? Time flies. No matter how many years you've been in this industry, I'm sure we have a complete wealth of experience and a wealth of knowledge in the different topics, right? With that said, some of the concepts within finance, you might be hearing for the very first time. We're going to spend the next 90 minutes or so together talking about the very fundamentals. Now, one thing that I will absolutely ask from each of you is please be kind to yourself in the process. If there's something that you do not know, say, I got it. I'm learning it now. If there's something that you look at a number and you're like, oh my gosh, I have anxiety around numbers. Guess what? We as stylists, one of the first things that we typically say to ourselves is, I'm not good at math. I'm not good at numbers. Those kinds of things intimidate me. The reality is that the stylist community, the beauty industry, has such incredible emotional intelligence. We can formulate, we can deal with clients, we can run businesses, we can run salons. One of my great goals is to really change the way that we talk about ourselves. What I would love for the next 90 minutes is your attention, but also the fact that you absolutely can get this. My role as founder of Beauty Finance Group is to bring accessible financial education to the beauty industry. Every single time that I've ever in my 20 years gone to a financial advisor, I've always felt there, even as an executive, even as somebody who can stand up for myself, I've always gone back and leaving there, I felt a little less intelligent and a little bit smaller. And my goal is to change that for all of us, because the reality is what you do on a daily basis, we can absolutely get this information. So allow me to share my screen and we'll go ahead and get started. Officially, welcome to the fundamentals of finance. Now, as I said today, we're going to be talking about the very key fundamentals. Are we going to learn every single thing we need to know about finance in a 90-minute section of time? No, but my goal is for you to take a couple of key takeaways to really spark the journey to financial freedom and financial literacy for you personally. If there's questions you have, finance is very personal, right? I also understand finance is extremely personal. The goal is to answer as many questions on a topic standpoint for you as you might have today. If there's something that you have as a burning question that you want to work on as a one-on-one basis, you'll know how to get a hold of me and we'll absolutely be happy to help you with after class as well. My request also is ask the questions that you have. Our incredible team, both James and Brittany will be addressing some of the questions in the chat room. So you're here. Thank you for being here. Let's make this time as well spent for you as possible. So what is our mission? Really understanding financial resources should not be a scary thing. We need to know, especially after the world of 2020, we've all survived a pandemic. And we know that understanding our research for a healthy life, protection of income, and building wealth are no longer optional. With that said, everything that we're learning about today is meant to be for educational purposes. This isn't meant to be personal financial advice. If you need personal financial advice, we can do that on a one-on-one basis, but this is meant to be for your educational development. So imagine this. You start an incredible career in the beauty industry. You work hard. We all work hard. You start making a good living. Might be that busy stylist. You're a successful salon owner. You spend your life making the world a more beautiful place. Maybe you get brand contracts. You become a rock star educator. You get to keep a thriving clientele. You're living the dream. And then one day, Now, that one day might look like a lot of different things. That one day might be, oh, by the way, salons are closing down for the next, unforeseeable future because we're entering a pandemic. That one day might be you slip and fall and you can't work for 3 months. That one day might be your partner experiences a hardship. That one day might be 1,000 different things for 1,000 different people. And the reality is that when we are working so hard in this industry, very rarely are we looking at what are some of the things that can happen over the course of a 30-year career. The reason I'm so incredibly passionate about this information is, over the course of 20 years, especially if you think about the last 5, when GoFundMe has become something that we are used to seeing on a daily, almost daily basis. We've seen stylists, salon owners, salon professionals, beauty rock stars that go from having it all to having absolutely nothing, to be left with a GoFundMe at the end of a very successful career. And nothing wrong with GoFundMes by any means. It's important to continue to support each other. But when we start to understand what kind of steps can we take along the way our careers, we can actually make better decisions so that when that one day happens, that we are protected and that we're set up for success. This is something called the service curve. Now, the reality is when we look at the beauty industry, and this is something that it took me a long time to really get comfortable with saying without having like heart palpitations. When we look at the beauty industry, this is one of the few industries that the longer we're in it, the less money we tend to make. Think about it. What happens in the first 5 to 7 years of our career? We are hustling, we are going in early, we're staying in late, we're actively building our clientele. We see our eye on the prize and we're like, I'm going to be that busy stylist. I'm going to be that salon owner. I'm going to be the rock star of I'm going to make it. And we do everything in our power to do so. And then what happens is we tend to plateau. We tend to be like, okay, I've made it. So we no longer focus on getting new business. We no longer focus on, really getting referrals. We no longer focus on really looking at a day-to-day, what does our day, say that said 10 times fast, day-to-day, what does our day-to-day look like? And so we tend to plateau. Now, where the danger lies is we actually start a very slow, but very steady decline. And that slow and steady decline is what gets us to make less and less and less money, so that when we're looking at the last 10 years of our career, when we're looking at retirement, it actually becomes a kind of a scary situation. One of the things that, again, looking at all of the stylist groups and everything else, there was one a couple of weeks ago where on one of the stylist Facebook groups, somebody had asked, what do we do for retirement in the beauty industry? And, some of the answers that were just populated in the comments was retirement. What's retirement? I'm going to work until the day of my funeral. I'm just hoping I die behind the chair so I don't have to worry about retirement because I'm never going to be able to do so. And while they're, kind of comical reading the comments because you're like, oh, haha, good one. Oh, haha, good one. When you look at the actual industry crisis that we're in, because so many of us weren't given this much information, weren't given the proper financial guidance when we were starting out our careers, it becomes really evident that unless we do this for ourselves, unless we really learn what needs to be done, we're going to be facing a pretty significant crisis individually and as an industry. So what are some of the things that we need to plan for to avoid even the passive decline as we go more and more seasoned in this industry? Well, think about inflation. We are living through hyperinflation right now. If you turn on any of the economy news, they're constantly talking about inflation. And we're actually living through a 10-year high of the rate of inflation. Typically speaking, it's about 3% a year. Now you might be thinking about what does actually inflation mean? We hear this word all the time. The simplest way of thinking about it is the purchasing power of $1. So let's just say that for $1 today, you can buy a loaf of bread. $1, thank you, here you go, I'll take my loaf of bread. Next year, you'll still have your $1, but guess what? That loaf of bread is going to be $1.05. So you are 5 cents short. So now you've got to spend more money to get the same items. And the reality is when we think about raising our prices as an industry, it's a collective panic of, and maybe you're really good at it. So if you are, congratulations, truly, truly, truly. But when we look at a lot of the time of raising our prices and keeping up with the cost of inflation, a lot of stylists and salon owners are like, well, how do I know what to raise my prices? We just went through a pandemic. My clients just lost their job. How do I raise my prices when people are suffering hardships? And the reality is that collectively, when we look at not raising our prices and keeping up with the cost of inflation, we slowly but surely make less and less and less money. So inflation is super important to think about. What about client attrition? Clients move, they leave us, they find other hairdressers. Some of them, stop doing their hair. All sorts of things happen. So client attrition, always keeping room for new clients, is really important. Now, this is the last one, and it's the one that's the least fun to talk about. But what about our physical decline? When you look at a 30-year career, our tools start to not be as quick. We start to not physically be as efficient. And when we look at kind of what's expected to happen when our ability to make an income is tied to our ability to physically perform, we have to plan ahead for a physical decline. Now, let me ask you this. Let's say that you were a farmer. Okay, you're a farmer and you've got a really big couple of acres of land and you've got 3 tractors. One's gonna, get the land all, whatever tractors do, right? They're going to toss up the soil. One's going to plant all the seeds and one's going to gather all the harvest. These are the 3 machines you have, and all 3 of them need to work for you to have an abundant harvest. And you're going to have this land and these tractors for 30 years. What would you do to take care of those tractors? You'd make sure they get proper oiling. You'd make sure that their tires are, nice and pumped. You'd make sure that they were properly protected just in case, something happened to them. We do this for things, but yet we don't do this for our physical tools. And so understanding proper protection so that when we count not only for inflation, not only for client attrition, but when we account for our own physical decline, that we make sure that we're properly protected. What are you hearing? What's coming up for you just in the chat room? What are you hearing when you think about this? Fully guilty of this. Yep, me too, quite honestly. Let's see. I agree. This class should be required in hair school. Absolutely. That's the goal, quite honestly. I'm already tired at 33. I know, Shannon, seriously. And that's the thing, that when we look at the length of time that we have to be physically active in our career, this becomes a really big issue for us. The other thing that tends to happen in our industry, and my personal story is the fact that my parents and I immigrated to the United States as refugees, believe it or not, at the age of 9. My parents worked incredibly hard. They taught me that you work hard, you don't say no, you show up early, you stay late, that you do whatever it takes, right? Fantastic. Did they ever teach me, oh, and by the way, this is how money grows? Did they ever teach me, oh, this is how money compounds? This is the type of investments? Absolutely not. Why? Because they didn't know. My mother's idea of wealth transfer was to buy a funeral plot, so we're not left with those expenses. And so the reality is, why I share that is, so many of us don't come from a background where we have that generational wealth passed down to us. And so, not only do we not know that information, we actually wind up having to, learn it for ourselves, stumble it, and hope that we can change it for our children's future, right? But the reality is that this information is out there. So when we talk about, how is it that the wealthy get wealthier? It's not just because of their money growth. It's also because of the knowledge. When we think about knowledge being potential power, right? Because when you know and you apply the things that you're learning, that's when true power tends to happen. The other thing, that's really important to consider is, what is your personal relationship to money? Money's funny that way. There's so much emotion around it. So for some of us, it's, overwhelm. For some of us, it's shame. For some of us, it brings up things with, self-worth. For some of us, there's a range of emotion, right? That money and our relationship to it brings up. Especially think about it through the lens of you doing what you do for money. Most of us with our clients, because it becomes such an emotional relationship, the money is like the last thing that we tend to think about. So I want you to just take a couple of minutes to think through these questions. Describe your personal relationship with money in 5 words or less, or 5 words or less. What does wealth mean to you? It's a funny thing. It means something different to everybody. And how do we measure that for ourselves? What is your idea of financial freedom? What are your sources of income? Believe it or not, that's something, that's really important. You might be thinking, well, I work behind the chair. Fantastic. Do you know what are your different sources of income from the business that you do behind the chair? How much of what you earn is yours? Think about that one for a few minutes. How much of what you earn is actually yours? How much of your money is working for you? What do you want your legacy to be? And what would you tell your future self about your finances? So for those of you that have the handout, please let's take the next 3 minutes to fill it out. For those of you that do not have the handouts, I'm going to keep these questions up. Just jot them down, whatever your preferred method of taking notes is, to really start to analyze what some of these things mean for you. So I'm going to set a timer for 3 minutes, and I will see you shortly. How are we doing? Just in the chat. You can, of course, verbally say it as well. I'd love to hear from you, but in the chat, what are some of the things that are coming up for you? What question resonated with you the most?
Anna, I just to talk out loud, like, how much of what you earn is yours is such a like poignant question. I'm like really having to think about that. And it could be different for everyone, which I think is so interesting.
That's the one that always gets me as well. Thank you, James. And Brittany said the same thing too, is, when we think about how much money we make and we think about all of the, one of the things that we talk about all the time is pay yourself first. Okay, great. It's like, how do I pay myself first? I think changing around the narrative of a part of all of I earn is mine to keep, or how much of what I make is actually mine, puts in a little bit of a different mind shift of, where is my money going and what is it? I work really hard. What is it that's mine? What is it that's just for me? And so as we're going to, through the next slide or through the next, presentation, essentially, always try to think that at the front of your mind. What is this doing for me? How much of what I earn is mine to keep? How much of this money that I'm working so hard for will earn money for me? So that in itself, if you really start to change that mind shift, it'll help you be more clear as to what your money is doing for you. Very good. So what are the sources of income? Thank you, Shannon. Yes, there's, these questions, again, we took like 3 minutes. These questions alone could be a whole workshop and a whole day of discussion. What I would love for you just for yourself is keep thinking about these. If you answered all of them, thank you for participating. If you only got through as well, when you have a moment just to really think and be with yourself, is continue to work on these questions because they're really important ones for you to know. Wealth. Yes, Kim, thank you. Wealth is not to have to worry about money in times of crisis. It's very true. It's very true. So, let's think about, well, when we look at, we talked about it, the lifespan of a 30-year career, what are some of the things that we have to think through? Let's also look at, when we look at from an industry, career, life standpoint. This is something that's called the X curve. Now, let me ask you, do you think that your responsibilities later in life are the same as your responsibilities right now? No. Right now, chances are your plates are very full. When you think about where you are in the very first part of life, right? When you think about the very first part of our careers, that about 20 years, what are some of the things that we're doing? We're starting careers, we're building businesses, we're starting families, we're actively working for our money, right? We're having children. Some of us wind up having to take care of our parents. So we wind up being in a sandwich generation where we've got to take care of, raising our little people up, right? Our children up. And then we also have to care for our elders, right? Some of us are in that boat as well. And so the responsibilities can feel very, very heavy. When you think about where are you in this point of life, one of the most important factors to consider is making sure that you are risk averse. If something happens to you, if something happens to your partner, and there is a loss of life or there is a loss of income, having proper protection when the responsibilities are really heavy and really abundant becomes really, really important. Because again, if you can't work, if there's not that financial abundance coming in, everything else will now start to tumble down. Now, what happens later in life? Our responsibilities tend to get less. I've got 2 children. I love them dearly. Do I want to be taking care of them when they're in their 30s? Just emotionally. I don't want to take care of them financially at that point in time. It's hopefully at that point in time, you are, if you have a mortgage, it's paid off, your life expenses tend to get a lot less later on in life. Now, what happens at that part of life? Well, we have to understand, did I make the right investments along the way where I can actually live off of the interest of all of the seeds that I've planted that got me to this point? Because at that point, the goal is that you're not actively working for money, that we're looking at how do we live off of our interest. The other thing that's really important to understand is how do I save my money from extra taxation? And so looking at what are the strategies that I have in place along the way so that I'm not paying taxes and then a 20% tip, right? I want to pay only the number of taxes that I actually have to pay. So saving your money from fees and from taxation also becomes really important at that point in time. The other thing is, how do I not outlive my money? Because when we look at, again, the retirement crisis in general, and when we look at the fact that, you guys, we need about 20 times our annual income for retirement. So think about your income times 20 years is what essentially we need to have. That number starts to get like, oh my God, how do I get there? Because now I'm starting to have a little bit of a panic attack take over. There are ways to get there once we understand how money works. But when we look at this thing collectively, it also helps us plan out, where are you personally in this journey? Are you in the thick of the responsibilities where you're like, oh my gosh, I'm completely up to my eyeballs in it, but I've got another, 20 years to go and I want to make sure I get there? Or are you like, no, actually my responsibilities are starting to get a lot less because I'm in about, the last 7-8 years of my career. So how do I make sure that what I can put in place now to really set me up for success, even in a more limited amount of time? And some of you might be just entering this crazy industry. And you might have another 30 years ahead of you to really plant some incredible seeds, to really have a fantastic harvest at the end of a career. So this is going to be very personal for you also. Oh my gosh, it's really important to know. And this is the thing, Brittany's saying this gives me anxiety, right? Here's the deal. Money conversations can be a little emotion inducing. They can be a little bit uncomfortable. But guess what? Unless we look at it and unless we talk these through, that's how we remember knowledge is potential power. That's how we actually take on and make better decisions for ourselves. Because here's the deal, and I'll share a couple of things with you throughout this presentation. No one is going to take care of you the way that you take care of you. And what tends to happen with so much of the financial conversation is that it can be sometimes so overwhelming to think about that we actually don't pay any attention. And guess what? Years go by very quickly. We are already through another year. Like it's November in just a couple of weeks. Years go by the way that months used to. And so small amounts today, small amounts 10 years ago, right? Like small amounts today are so much better than waiting until you have a perfect financial situation, until you have a perfect, salary, until your clientele balances back. It is making small steps and planting those seeds along the way right now. What I would love for you to do, and we'll take like We'll take like 90 seconds to do this. This isn't going to be a really in-depth one. What I would love for you to do is write out the responsibilities that you have and where are you in this timeline. So imagine the very, very left side of this age gap being 18 and the other side, the very, very right side being, let's say 80. Okay, where are you in that timeline? So let's take the next 90 seconds to do that. What I would also love for you to do is what are some of your key responsibilities right now? Where is your income coming from? What are some of the responsibilities that you have right now? And what are some of the ones that you anticipate having or not having, more importantly, when you are closer to 60, 70, 80? Let's take the next 90 seconds and I'll put us on. End time. That was a quick one. Just off the bat, what are some of the responsibilities that are coming out for you? Let's share in the chat. So if there's something where you're like, oh my gosh, I'm not even sure what's coming out for me, if this can feel overwhelming, the most important thing to know is, oh, kids' tuition, family, adults. Yes, yes, yes. Super, super important. Childcare. Childcare is incredible. Raising a kid, mortgage, rent, retirement. Yes, we are completely in the thick of it. And so what is the long-term plan? When you think about anything from a financial standpoint, it's looking at what are the immediate short-term goals, right? And what are our goals and intentions for 5 years, 10 years, 20 years, 30 years, depending on where you are on that timeline. When you think about all of the things that you're balancing, there's a couple of key things we're going to be talking through today to really help prioritize and help to understand what are some of the things that we need to do today to make sure that we're protected, to make sure that we have our money working for us, but then also to make sure that we're setting ourselves up for success for the version of us 20 years from now. So when we look at, when you think about financial planning and when we look at everything as a whole, what are some of the areas that we absolutely need to pay attention to? There's things that happen that are within our control in life, right? So how much you save on a regular basis is within our control, even though sometimes it might not feel like it. Children's college planning, personal savings, our mortgage, our home situation. Those are things that we somewhat can have control over. We have to consider the things that we cannot control. So becoming dependent, suffering health issues, God forbid, premature death, becoming disabled, right? Really bad things sometimes happen to really incredibly good people. So having this, not manifesting any of the bad stuff, but having protection in place in case that this happens is really important. But we have to look at the growth opportunities of increasing our wealth, of estate preservation. We're not going to go into estate planning too much today just because of the time. But if you own any sort of property, if you have children, planning an estate and doing a trust and will is incredibly important. When you look at the financial importance, when you meet with a financial planner, that's actually usually like one of the top 2 priorities is are your assets protected from a trust standpoint? This is really important. If you have a trust, if you have some sort of estate planning, it doesn't have to be complicated. God forbid, should something happen, you want to stay out of probate. Probate takes thousands of dollars and years of your life. Okay. So if you need resources like that, I'm happy to send you links and everything else in like a really simple way of doing it. But these are the things that we really have to start looking at. Will of power and attorney and a financial security plan. So, when we talk about increasing wealth, when we talk about investments, those are things that you think of when you think of finance, right? When we look at the 4 categories of what are all of the building blocks that we actually have to create to have a secure foundation financially. At the very, very base is protection, again, for all of those unforeseen things. It's debt management, because debt is a very selfish beast that will continue to take unless you know how to manage it. And we'll talk about that in a second. Having an emergency fund. Do you guys know that in savings accounts and emergency funds aren't the same things? It took me a second to be like, oh yeah, no, actually emergency funds and savings accounts are not the same thing. So how do we plan for that? How do we know realistically what we actually need? So Susie Orman taught you that. Fantastic. Thank God. Yeah, Susie Orman's a good one. And investments. Now, investments are the ones that we really look at and we're like, oh, that's really fun. That's really fun. Those are like the sexier ones to talk about. But the reality is that unless we have proper protection, unless we have management of our debt and we can control that, unless we have an emergency fund in place for the what ifs in life, any investments in assets will continue to be declining very, very, very quickly unless everything else is in place. So having, they say never put all of your eggs in one basket. Having an understanding of each one of these categories is also incredibly important. Now, what does this currently look like for you? What I'd like to do is give you a little bit of time to think this through for yourself. When you look at protection, what are the things that you have protected? Chances are your cell phone is probably insured. If you have a house, chances are it's probably protected and insured. Some of you may have renter's insurance. Do you have things like disability? Do you have things like life insurance? Do you have things like long-term care? What are the assets that you have protected that pertain to you personally? Debt management. Do you know how much debt you have? And I say that respectively because some of us, it's so overwhelming to think about that we're like, actually, I'm not even going to look at it. I'm paying my payments and it's too overwhelming to think about. The average person in the US, the average individual has over $6,000 of debt. Some of us may have, 5 times that. Some of us may have no debt, which if you don't, congratulations. Understanding how this works is incredibly, incredibly important. An emergency fund. What is that for you? Is that a certain number of months or is that a certain dollar amount that you're aiming for? And investments. Do you have any sort of, do you have an IRA? Do you have, what are the investments that you have for yourself? So this isn't something you're going to have to share with anybody else. This is something that I want you to take stock of for yourself to see what are the clear areas of opportunity that when you think about for the next 6 to 12 months for yourself, so you can kind of highlight priorities of how do we now help you with the information that you're going to learn today, build a clear and a healthy financial foundation for yourself. Any questions before we do this activity? Okay, let's take about 2 minutes. I'll check in 2 minutes. And if you need more time, we'll take more time, but let's take the next 2 minutes to work on this, please. If you have the handout, please use it. If you do not, just literally write out the blocks on a piece of paper with protection, debt management, emergency fund, and investment. So the question that Suzanne asked, thank you for asking, is what is the average number of months you should have in your emergency fund? That is an excellent question. If you are if you are if you're the primary breadwinner or if you're in a one income household, typically speaking, you need to have 6 months of income set aside for your baseline expenses. If you are in a 2-person or in a partnership where it's a 2-person income unit, then you have 3 months. The reason is that chances are within those 3 months, one of the people will be able to have a source of income back. So 3 to 6 months is the answer. When we looked about, prior to COVID, it's like, when am I ever going to be out of work for 6 months? When am I ever going to need 6 months? And the reality is that there are times of life where we will need 6 months. The other thing to really, the lesson that I learned after, what we all collectively went through was the fact that if we're struggling with 6 months of no income, what happens when that's 6 years? What happens when that's a much more significant amount of time? And the reality is that at some point in our lives, we are going to face that. So what can we do right now? What can we do tomorrow to make sure that when that time comes, that we are in a place of not scarcity and not fear, that we have properly set ourselves up for success. What were some of the things that were coming up for you? So with protection, with debt management, how did debt feel actually? Does everybody know, I know it's not a fun topic, but do you know off the top of your head how much debt you have? Personal protection, yes, a lot of us do. So let's talk about personal protection, actually. We're going to talk about that in the next topic. Let's see. So how many of you were like, nope, I'm personally protected, I'm good. If something happens to me, I'm good to go. So maybe a thumbs up in the chat if you're good to go. So life insurance terms versus life, we're going to talk about that for a second. Yes, good to go. So whether you're good to go, whether this is something that you need, it's important with when you talk about insurance, when we talk about protection. I'm going to share a couple of key things with you today of how do you determine that for yourself. Anytime there's any sort of a commission involved, right? When somebody is trying to sell you life insurance, a lot of times it feels like, okay, am I just being sold? Like, are you trying to upsell me on something that I don't need? As an industry, this is really, really important to understand what's what, so that we can start to make better decisions for ourselves and that we're not paying more than we have to. And that even in the money that we're putting in protection, we're making it work for us. We're going to talk about debt as well, of what are some of the debt payoff methods? How does debt work, right? So that we can start to get ahead of that beast if that's something that you're struggling with. And then how much do you need you personally? What is the amount that you need a month for your emergency fund? And then of course, we'll talk about some of the fun investments. So what are your assets, right? Assets are income producing investments. And, when we look about cash and cash equivalents, investment assets, personal use assets, like our house, maybe our car, like things that we like to splurge on. The reality is that when you look at all of the assets, you are your greatest asset. And that may sound a little corny to you, like, of course I am, but realistically, your ability to make a living, without that, nothing else matters. You truly are your greatest asset. So what are the things that you need to know to make sure that you are protecting yourself? What are the questions that we need to ask anytime, whether it's disability, whether it's long-term care, whether it's, life insurance? What are the questions that you need to ask? What is the amount that I need to protect? That is going to vary for you different times at different stages in your life. That's also going to be different for you than it is for anybody else, right? Is how do you determine the amount that you need to protect? Understanding what your policy will pay for. Insurance companies are notorious for not paying or being difficult to work with. Understanding what you're getting up front so that you're not surprised or unpleasantly surprised down the line is very, very important. Will I have long-term care in this policy? You guys, for us as an industry, because what we do is physically tied to our ability to make a living, long-term care is really, really important for us to look at. And can I use this policy as an investment, or is this a use it or lose it policy? That's also really important to understand. When it comes to, I'm talking about long-term care versus disability. So there are things like AFLAC, which are incredibly important because it's short term. If you slice your finger really badly during a haircut and you just like, oh my God, I can't work for the next 3 weeks, right? Things like AFLAC will protect you. Short term, it's quick. Things like AFLAC, short-term disability, will expire when you are 65 years old. There are some companies that will go until 67. But disability insurance is not a thing after 65 or 67. The majority of the companies only cover you until you're 65. So if something happens, if you're still behind the chair or when you need disability insurance later, it is not going to be available to you. That's really important to know. Long-term care will go through the end of your life. Long-term care is something that you need long-term care for. With certain policies, you can actually attach it to a policy, to a life insurance policy, where let's say if you have, like $500,000 of coverage, you can get 2% of that a month tax-free when you qualify. So that means you can get about $10,000 a month to live off of if you qualify. So when you attach it to a life insurance policy, it actually becomes a lot less expensive for you. If this is something you're shopping around for, the word that I need you to know, and please write it down, is cash indemnity. Cash indemnity. What cash indemnity means is that it will make you whole again. So certain insurance companies will say, okay, great, we're going to give you, $200 a day. And you're like, okay, but my medical expenses or my care expenses or my cost of living is actually like $300 a day. Well, they're going to say, okay, well, that's nice, but we're giving you $200 a day. And you're on the hook for that other 100. Some insurance companies will say, okay, well, great. Yes, we completely believe you. Of course, we believe you. We have your doctor's information and everything else, but do me a favor and send us your receipts and then I'll reimburse you for the expenses that you're incurring. The last thing that you want to be doing is fighting with insurance companies for reimbursement. That's the last thing you want to be doing, especially when you're in that place of need. So making sure that your insurance policy has an indemnity clause, that basically means you're going to get an amount a month, right? Predetermined, you're going to get that amount a month. What you spend it on is your business. You're not having to fight with the insurance company. You guys, that in itself is highly, highly important. Any questions on this so far? So Kiam's asking is, does protection include long-term health care after retirement? Yes, and that is when, especially long-term care. So there's like, depending on the age that you're in, there things like Medi-Cal and Medicaid kick in at a certain point, right? There's also the care that you have. So your daily living expenses when you cannot do 2 of the 6 daily living activities. So for hairdressers, funny enough, the #1 claim for going on long-term care is actually back issues. And that's across the board. So think about for our industry, you have been standing on your feet for the last 30 years. Chances are your back, your hips, your wrists, all of these things will allow you to qualify for long-term care. Do you have to be fully disabled? No, you do not. Do you have to be able to not work? No, you do not. It's not being able to do 2 of the 6 living activities, which is getting out of bed yourself. If you cannot give yourself a bath without having like one of those handicap rails in your bathroom, right? That's a qualification for long-term care. So there's a lot of things like that where you actually can qualify. And again, that is 2% of a policy. Is the cash indemnity need to be a part of long-term care? Yes, it does. Good question, Mitch. That's especially when you want it, because once you're actually, when we all eventually pass away and our family gets, our whatever's left of our life insurance or our life insurance, they're not submitting anything. That's the amount that they get. When things like cash indemnity come into play is when you're using that policy for things like long-term care or for being able to utilize it to your, for more of your living expenses. Good question. So when we look at type of insurance, right, and I think a lot of us know this, but it's important to understand the differences between the two. When we look at life protection, there are things like term insurance, and there's things like that's called permanent life. What are the main differences between the two? Term insurance doesn't have any cash value associated to it. And I'll talk about what cash value is in a second. It basically means I'm going to be buying insurance for the next 20 years. And the most common time where you will be able to purchase a policy is usually a 20-year period of time. And it's typically really inexpensive. Sometimes they don't even make you go through blood work. It's like, nope, I'm going to pay, $50 a month for an X amount of coverage. And if I don't pass away within that 20 period of time, this is just like peace of mind that I'm buying. If I do pass away within that 20-year period of time, then my beneficiaries will get, my income essentially that I would have earned. They're going to get whatever that amount is. It's a really quick, very efficient way from a finance point to get protection. Where term insurance starts to get tricky, where it sometimes can be a not great investment over time, is that if you don't use it, you will lose it. So if you're paying into a policy for 20 years and you are healthy and you don't pass away, hopefully not, within that period of time, you lose the money that you've put into it. It's like renting an apartment. You live there, you pay for it. When you move out, thank you for paying the rent, but you no longer have access to any of the assets that you've invested along the way, right? If you work for a company that provides life insurance, typically that's also term. When is term good is, I'm on a budget. I need to make sure that we're good for, the next 10 years if something happens. It's a great way to get safety of mind. Where is term insurance not great? When you want to get your money working for you outside of the actual life protection. So then there become things like permanent life insurance. Permanent life insurance will give you that peace of mind if you pass away or your partner or whoever it is, if there's loss of life, but a portion of what you're paying will also be invested in something that's called cash value. What these companies tend to do, what insurance companies tend to do with permanent life insurance is, let's say I am healthy, I'll use myself as an example. I am a healthy 40-year-old female. And I don't have pre-existing health conditions, right? I have thyroid, I have Hashimoto's, but that's to my extent. It's managed. So I'm able to get, let's say, $500,000 of insurance, and my payment is, $200 a month. Great. The likelihood of me dying from the insurance company standpoint is fairly low in the next 30 years of my life. So by $200 a month that I'm paying, $90 of it is going to go for like the protection, and the other $110 of it is going to be invested in a cash value account that I set up as an index strategy, which basically means I'm going to follow an index like the S&P 500, and that money month after month after month is going to grow and calculate and grow wealth for me, so that when I'm 65, based on my numbers, I probably will have another $150,000 of money that I can pull from the cash value. So when you're dealing with permanent life insurance, understanding how cash value works is really important, because it can actually be another tax advantage, tax-free growth strategy if you know how to set it up correctly. When you're talking about like college planning for kids, one of the ways to like transfer wealth is actually through the cash advantage in life insurance policies, because there's a tax safety essentially where that money isn't considered income, but you have access to that cash and it grows tax-free for you year after year after year. Within permanent life insurance, there's a couple of different categories. There's something called whole life insurance. Typically speaking, this is the oldest in the book. It's like the catalog. It's going to be kind of big. It's going to be kind of expensive, and it doesn't necessarily have a lot of changes that you can make year over year. My personal kind of recommendation, and I'm not giving you advice, but what I have for myself is the indexed universal life. Indexed universal life allows you to make changes to the policy. So let's say right now I am doing well. I can put a little bit more money towards it because I actually want to grow my cash value a little bit. And let's say next year, you know what? I won't be able to. And I actually need to pay like the absolute minimum amount of payment that I can change my premiums. This is really important, that as your life grows and changes, that you are able to have that flexibility. Anything that has universal in front of it will give you that flexibility. Is it to borrow? Is it better? So really good question. Okay, so a couple of questions. So Kim's asking, is it better to borrow from the life insurance cash value or cash it out? You're better borrowing from it. You are better borrowing from it. Why? Because when you borrow from it, most companies have something called a wash loan. This is another term that's really important for you to know. Something that's called a wash loan provision. What does that mean? When you borrow money from your cash value in the policy, a lot of times they're going to charge you a couple of percent. What a wash loan provision does is credit you back the same interest. So you're using that money penalty-free. You're also not paying taxes on that money if you are borrowing against it, right? So that's really important. When you cash it out, you're going to, chances are, pay taxes on it, right? Because, or you're going to have to pay taxes on the earnings, on the interest, not on the premiums that you've paid into it. But also when you cash it out, when you pass away, that policy is gone. If you're planning to cash it out, look at something called return of premium. Return of premium basically means that when you cancel the policy, anything you've ever paid into it, you will get back. So these are things that are important for us to know. Again, it's not like, oh my God, I'm going to learn about life insurance. But trust me when I tell you is that when you need this information, it is worth its weight in gold, because this is how you get your money working for you in every single thing that you do. Now, how are these premiums typically? How do we know, like, what are these premiums? How are they determined, right? They're determined on a couple of different factors. So your height, your weight, your health issues, past or present, use of tobacco, your medications, your family history, your driving record, your criminal record, any high-risk activities. So for example, if you are a skydiver, if you like to, go on bungee jumps, right? Chances are maybe don't include that in your application, or don't like post about it for the next, for when you're applying for something. When you're applying, the other thing that I would recommend is maybe do like and I'm this serious, do like celery juice and lemon juice for a few days before it, because when you have like the best place that you can be from a blood health stand, the lower your rates are going to be. That's important. What happens when you apply for a policy is there's something that's called underwriting, and they're going to go through your medical history. They're going to make sure like how much of a risk are you? So the better you can position yourself, the better rates you're going to be able to get. Pre-existing conditions got me big time. Yeah, no, it's exactly right. Because those underwriters will find anything. And the interesting thing, you guys, I've actually helped a couple of people that were like declined for insurance. And it's like, why was that person declined? It's like, oh, he's got diabetes. And so I'm like, do you have diabetes? He's like, no, I don't have diabetes. And they're like, well, have him go to the doctor. He's got diabetes. So sometimes they'll actually find things that the people like this particular person didn't even know that he had diabetes yet. So they will find anything and everything. So the better you can position yourself, the lower rates you will have. And typically speaking, these terms are either, there's something called annual term, which is year to year to year to year. You want to avoid it if you can, because that's going to be the most expensive. Kind of the bummer about term insurance when you're getting it is the fact that it is going to, every time you go to renew it, it's going to be significantly more expensive. So let's say you're 30 years old and you're like, nope, I'm good for 20 years. I want to get term and it's going to be really inexpensive for me to get. When you're 50, you're going to be significantly more costly to insure than you are when you first got the policy. So your prices go up significantly. So if you're looking at this and you're like, nope, I'm young and healthy, or I'm healthy, right? Look at weigh your options of what will you get with something like an indexed universal life on a monthly basis, and what that will do for you in the next, 10, 20, 30 years from a cash value standpoint versus like a term policy. Because those kinds of things, once you're in, you're not having to apply for renewal. You're not having to like submit, even if you have a health crisis, you're not having to reapply, which is important. Again, make your money work for you. Because listen, you guys, we work really hard for our money. It's time to figure out like, what do we do? How do we make it work for us? So how do you calculate what is it that you need? How do we calculate? Because again, anytime there's commission involved, when somebody helps you with a life insurance policy, you're like, okay, great. So if I buy like $1 million, you're just trying to tell me that because you get paid more on it, right? And there is something to that. I've seen some really crazy things when we're helping people and reviewing things where it's like, oh yeah, no, that guy completely oversold you. And so understanding like what it is that you need and what is it going to do for you will save you thousands of dollars along the way. So how do you personally determine what you need? It's something that's called the DIME method. DIME stands for debt, income, mortgage, and education. We want to look at all of our consumer debt, our income times 10 years. So your income times 10 years is what's the most important thing to protect. Your mortgage, or 10 times of your rent, or 10 years of rent. Education. Now, education is either for any loans that you personally have for education. It's also where we include children. Typically speaking, you want to add about $100,000 per child. Yeah, I know Suzanne's like, oh. Typically speaking, if something happens, you want to have about $100,000 dedicated per child, so that if you're not able to be there to work and pay for their expenses, that this is something that's already covered. Now, when we look at, again, understanding the differences between what are our permanent needs and what are our temporary needs, right? Debt, it feels permanent, but debt is temporary. We can get rid of debt. Our mortgages are 30 years or less. Mortgages are temporary expenses, long-term temporary, but they are temporary. So is our education or our childcare. Those things are all temporary expenses. When we look at our income, that income times 10 years is what should be at least the base of that permanent insurance policy. Now, why 10 years? Well, it's been proven that when there's a catastrophic event or a loss of life in a family, it's the average number of years that it takes to be whole again is about 10 years. So again, we don't want to plan for bad things happening, but we want to make sure that if they do, that we are protected and our families aren't struggling more than they have to, right? Because that's already catastrophic and hard enough. So let's take the next 2 minutes and figure out, what does this look like for you specifically? Okay, just an exercise. You don't have to share this with anybody, but when you go to have this conversation, I want to make sure that you have the right tools to be able to have that conversation in a way that you own the power. So let's take about 2 minutes. What is your total debt? What is your income? What is your mortgage balance? And what are your children or education expenses? And go.
And I think there's a couple questions in the
please.
chat just that will help set up them filling this out. And so one of the questions is the income for 10 years include spouse's income?
You could do, I would do this individually, because that's a good question, because you're essentially establishing the coverage per person that you need. So this is something that you want to do for yourself. And then you would do one separately for your spouse. Good question. Was there something else?
There's another one that's not for this worksheet, but saying I'm healthy, my husband's not. Am I better to apply without him? Will it affect my ability to get coverage?
No, so that's a really good question. So life insurance or disability insurance, those things are very personal. So your husband's health or your wife's health will not affect your coverage. So because it's based on your personal history, it's based on your blood work, it's based for you specifically. So, I mean, there are products that you could get jointly, but if that's the case, you absolutely want to get something that is separate, where it's just for you, and something separate that's just for him. Your rates are also going to vary quite a bit. And the type of product actually that you might get is going to vary if he has health issues. He might be able to qualify for something that's term, quite honestly. He might not be a candidate for even long-term care. And unfortunately, that's why sometimes it's like, okay, how do we do this while we are healthy? Because if there's any sort of a risk factor, sometimes they're like, no, we're not going to move forward with it. Good question. Any other questions before we do this?
I think we can go into the exercise. Thanks,
Okay,
Anna.
thank you. So let's take the next 2 minutes. Please fill this out for yourselves. Let's go. I think I may have cheated you out of like 20 seconds, but I want to move on with so many other things that we still need to talk about. How does that feel for you in filling this out? Are you surprised at the number that you maybe are like, I wouldn't have ever thought about this? This is important for you to know, again, so you don't feel like you are being sold something that you do not need, but you're actually buying a resource of protection that will be beneficial for you, right? So this for me is just, again, a simple tool that when you're having that conversation with your finance or your insurance professional, that you have to your advantage. If you need resources, I can also forward you to a few people that can very efficiently help you with that, but just putting it out there. So there's a couple of questions on the, I think the differences between 529 accounts. So 529 accounts are college savings accounts. It's a fantastic savings account. It will also grow, for you tax-free. The only thing with the 529 accounts is that they have to be used for educational purposes. They have to be used for educational purposes. It's actually, so funny enough, 529 accounts are something called municipal bonds. So it's a lot of times something that your state will sell you as a bond, and it's categorized as a 529 account. They are transferred they can be transferable from child to child. So let's say your oldest is like, yeah, I'm going to do the entrepreneur route. You can now transfer that account to your youngest, to a cousin, to somebody else. The beauty of them is that, they grow steadily. You're going to have long-term growth. Colleges love them. You can actually fix them at a rate where you're purchasing future education, or you're purchasing future commission at today's rates. So somebody had asked the question about education inflation. 529 accounts, depending on how you set it up, can help you beat that. The other option to look into for children, especially if you have young children, is that cash value in the insurance policy. Now, I know sometimes it's like, I don't know, kids insurance, life insurance, what are you talking about? It's not for the purposes of protecting your child's life, right? God forbid. It is for the purposes of putting money in that cash value so that you can borrow against it, again, with that wash loan. There's something called the $1 Million Baby policy. when you start your children with that cash value, they're literally millionaires by the time it's their time to recover. So or retire. It's a very efficient way of creating generational wealth. And especially when you get them, started when they're younger, like it grows so incredibly quickly. So that's just as a parent, I was like, this is a really important thing for us to know. And that way they can use it for whatever they want. If it's an entrepreneur, if they want to do, take the creative path, like so many of us here have, they can also be set up for success that way. It's really important to know. With that said, though, here's a fun fact about that. People are also sometimes crazy, right? And there's some bad people in this world. And so with those kinds of policies, the base amount cannot be more than the parent's amount. It has to be at least 50% of your coverage. What that means is if you have $1 million of coverage, your child cannot have 750,000. They would be like 500,000 and it would grow towards that. Again, because some people do some really, really awful things. So they also want to make sure that the children are protected. Any other questions on this before we move on? All right. So debt. Of all the bad 4-letter words, it's by far my least favorite, and it's the one that's going to get you the worst. So how does debt work? I know for so many of us, it is such a struggle. And when you really understand how debt works, it really is like walking on quicksand. We're going to talk about compound interest shortly. Debt highly, highly, highly compounds. What that means is your debt is earning interest, and then your interest on that debt is earning interest at a very, very, very high rate. So what tends to happen is when you go to a traditional bank, let's say, and you put your money in savings, you're like, I'm being smart. I'm going to put my money in, or in my savings account, or even in a high yield savings account, or in a CD. And the bank is going to give me about 0.5% back. Like the high yield savings account are literally 0.5%. And they're advertised as, oh my God, we're going to give you 0.5% back. Okay. So I'm going to put my money there and I'm going to get 0.5% back of interest. But then when I go to use my credit card, that same bank is charging me 26% to borrow money. So when you look at how predatory this cycle is and how truly predatory, how hard it is to get out of it, it's really important to understand what are some of the strategies that we can utilize to get out of debt quicker. There's two that I personally really like. That one is the debt snowball method. Just jot that down, debt snowball method. One is called the debt avalanche method. They both involve the same monthly payments on all of your combined debt. So it's not you having to now all of a sudden take every single penny that you make to try to pay off debt. We come up with a standing monthly budget, and what you allocate to different credit card payments changes, and you're paying them off typically about 1/3 of the time less. We now don't have a lot of time to get into it today too much. If debt is something that you're struggling with, and I have like an Excel sheet that you can plug it into that literally will give you a debt payoff schedule. If this is something that you are struggling with, because you're here with Bumble and Bumble, please reach out to any of the Bumble team, and I will happily send this and share this with you, completely complimentary, and it's completely at your discretion and confidential, so that you can start to do this. Because again, when you work with some agencies that like relieve debt, those don't do great things for your credit. So again, depending on what your personal situation is, there is help. What are some of the things that you have to do initially, right? Is make a list of all of your debt. There's so much shame that comes with debt for us, because it's so overwhelming. I don't even want to look at it. I don't want to think about it. I'm just going to pay my payments. I'm going to send it in because it's too big of a beast to face. And you guys, that's how they get you. That's how they get you. Did you ever like look at a statement and say like, okay, I've got $1,500 and it's going to take me 7 months or 7 years, 8 months, and it's going to be like $6,000. And you're like, okay, I know that I wasn't like a math major. However, this does not make sense. It's because of how highly compounded that debt is. And I'll show you what that is in a second. So look at it collectively, gather every single thing. And then if this is something that you are struggling with, literally we can share an Excel sheet, you can plug it all in, and it'll give you a payoff schedule that will take the madness out of it for you, and that will get your payments down in a third of the time, and will build your credit, because when you're paying it off strategically over time, it also does amazing things for your credit. The other thing right now is so many of us are experiencing financial hardships. So it's always worth a try. Call your credit card company, see if they're willing to negotiate with you. Either they have, a debt, sometimes an interest reduction. If you're also looking at doing a large purchase, let's just say you're like, nope, I need a new couch and it's going to cost me $3,000 and I don't want to take it out of my bank right now. I just want to put it on my credit card and pay it off over the next year. Life happens. We all get into those kind of situations. Always call your credit card company ahead of time and just say, hey, do you have any or do you have any special offers? A lot of times what they'll say is, yes, well, I can't lower your current interest payment, but what we can do for you is offer you, 0 interest for the next 12 months. Sometimes there are those kinds of things, but pay them off, literally put yourself off on the schedule, because what they also plan on is you not paying it off in those 12 months. And then you go to the 26% interest rate. So again, it's the more we know, the more we can take advantage and find loopholes in the system. Any questions on this? How would you use debt as leverage? Family member was so scary, but they helped us out a lot. I'm not sure. Debt as leverage in terms of, I'm not sure if I fully understand the question, Kim. I recently had to do that for a family member. It was so scary, but it helped us out a lot. Yes. So, I mean, again, debt happens. And when you look at, okay, let me ask you a question, actually. Do you think it's more important to get out of debt or have an emergency fund? What do you think is more important? So who thinks it's getting out of debt? Get out of debt. Okay. Who thinks it's emergency fund? Okay. So it's about, listen, it's going to be like 50-50 down the line of what we think is more important. The reality is that when there's a strategy in place, you can do both simultaneously. So if we look at a budget per month of what is it going to be, what if I'm just snowballing my debt, if I'm using the debt snowball method, what is my monthly budget? Okay, great. Now, if I really start to look at how much of what I make is mine to keep, how can I think about paying myself first and putting and saving more money, keeping more of what I make, and start to build that emergency fund? We've got to do both simultaneously, because what happens when I put everything that I have to paying off debt? Life happens. Emergency funds don't have to be catastrophic events that like stop our lives. Sometimes your tire blows, you need a new tire. Your AC unit goes out, you need an AC unit. Your kid falls and breaks a tooth, there's $1,200 right there, right? Small things in life happen that set us back all the time. And if we don't have that emergency fund, the minute that one of those things happen, we're right back into debt. So having those two separated and planned for is really, really important. Now, one of the things that I would love for you to do is, just from a mental standpoint, is which circle are you in? So some of us look at, okay, my grandmother. So I'm named after the original Anna Manukyan, as I like to say, and she did not know how to read or write. She had 7 children. She was a widow at 43. She got married in Iran at 12 years old. This woman literally did not know how to read or write. My grandmother always had money, always had money. How did she always have money? Because she was like, nope, a part of everything I have is mine. I'm going to put it under the mattress. And when one of my 7 children needs something, I'm going to have money so I can survive. It was a mentality, right? It was a mentality of, I got to have my little stash, my little nest egg first, and then the rest of the world I can worry about. And then so many of us, myself included, are like, all right, so I've got some income coming in, fantastic. What are all of the things that I need to get? What are all of the debts that I need to pay? What are all the bills that I need to take care of? What are all of the presents that I need to buy? Of course, I'm going to attempt to save at the end of that. And really, when we look at just that mindset, and when we start to look at, okay, how do I make sure that I am in taking care of myself first mode? That I am in, regardless of what happens on my external circumstances, that I've got my little nest egg. When we really start to make that mind shift, we also get better at budgeting, because all of a sudden it's not as important, to have that extra thing on Amazon, right? I tend to get into midnight sprees when I'm like looking at Instagram or TikTok. TikTok now is the worst. It's like the TikTok made me buy it because I'm like, oh my God, that's so cute. Oh, I need that. And then I catch myself when it comes to my house 2 weeks later, I'm like, I don't really need that. Why did I get that? Right? When we're mindful of it is when we start to make better changes for ourselves. So what would you guys say, just in chat? Which circle are you guys in? Save first or spend first? Typically about 30% of us, it fluctuates. Yes, it does. So typically about 30% of us are natural savers and about 70% of us are natural spenders. It's about having mindfulness around what do we want our money to do for us. What I would like for you to do, and we're time-wise, I wanted to have you do this today. What I would love to do is have this as homework for a follow-up for you, is when you look at having this sheet and really identifying how is it that we can start to pay ourselves first? Okay, how do we really, realistically, we have a lot of expenses, and guess what? Life only gets more complicated until we get to a point where our responsibilities significantly start to decline. Life only gets busier, more expensive, and more complicated. So how is it that I pay myself first? What I would love for you to do as homework is list all of your sources of income. Some of you may have other sources of income outside of being behind the chair. If what you do for your sources of income is in the salon behind the chair, list those out. How many of your incomes come from specific types of services? And know what is your return on the time of investment for those services. So if you happen to be, a full cosmetologist, that maybe you do nails, maybe you do hair extensions, maybe you do, color and everything else. And you're like, okay, well, my hair extension clients, and I actually recently worked with somebody that did this, and she's like, wait a minute, what I get for an hour of doing hair extensions is like 5 times more than what I get an hour of doing nails. Why am I still taking nail clients? One example, right? Because when we're used to providing services, oftentimes we don't want to say no. And so identifying what gives you the biggest return on your time is really important. Now, additionally, what I would love for you to do from that is, what is that for you on a daily basis? If you were to look at 10% of your daily income, what would that look like? What would it look like 15% of your daily income? What would that look like? What about 20% of saving your daily income? The reality is that, if you open a Roth IRA account, a Roth IRA account has a maximum contribution of $6,000 a year, $500 a month. And $6,000 a year might be like, okay, where do you want me to find now $6,000? You want me to have an emergency fund? You want me to be debt free? And oh, by the way, you now want me to have $6,000 that I contribute to this income. What does that look like for you, depending on how many days you're behind the chair? What does that look like for you on a daily basis? The reality is, you guys, $10,000 a year, so an emergency fund plus a fully funded Roth IRA, is only about $27 a day. So when we start to look at, oh, okay, how am I going to climb that Mount Everest? It's one tiny little step at a time. You're not running or sprinting to the top of any hill, right? It's one small step at a time. The more you can make it broken down for you in attainable little bites, the easier it's going to be. Bumble & Bumble is an incredible salon partner. When you look at, okay, can I add on, a conditioning treatment? What can I do from a retail standpoint? Do you know you can actually pretty much fully fund a Roth IRA just by the partnership that you have? So when we start to really kind of look at it from that standpoint, it becomes a lot more attainable. But no one tends to have these conversations with us when we start these careers, right? And so we find ourselves in a place of, oh my gosh, I wish I knew this sooner. But guess what? Knowing today and starting today is much better than not knowing for another 5 years and not doing anything about it for the next 5 years. Any questions on this? Okay, so your emergency fund, this is actually also going to be homework. Your emergency fund, we said it, is not your savings fund. What I would love for you to do, just as homework, as a practice, if you can do this, we're Monday today. If you can do this for the next Monday to Monday, and just test it out. I'm never going to tell you not to buy your coffee. I'm never going to tell you to avoid Starbucks, not going to tell you to do those things. I'm not going to tell you to do those things. But how we get to keep more money is by either we have to make more, or we get to keep more of what we have. And so it's not about, being completely frugal and cutting off all joy in our lives. It's not about that. It's being intentional with what money are we spending. Just being intentional. Like, yes, I really want this. I really want this. I'm going to have this. Versus, I didn't really want that. And then I wound up wasting it. So what I would love for you to do for the next 7 days is literally, I'm happy to share an Excel sheet where you can plug it in, or you can even do it in your notes, of track every single expense, big or small, and categorize it by, the amount, the date. And is it a want or is it a need? 2 things just next to it. Is it a want or is it a need? That's all. Don't just do as you need to do. Keep going about your week, want or need. In a week's time, what I would love for you to do is take a look at all of those wants and see how much of those are still wants a week later that you're like, nope, I wanted it, I got it, I enjoyed it. Mwah, fantastic. I'm glad I did that. And how much of those wants have actually become wastes where you're like, I forgot about that completely. Yeah, I'm just going to go into the goodwill pile, and really start to minimize those wastes. Because what we do with wastes, when we start to get that income invested, it creates really long-term magic for us. So this is going to be homework for you as well. And, we talk about prior to one other couple of things that I want to tell you about prior to finishing. I do want to ask you, because we are a few minutes over and I want to make sure we're respective of time. Are you good with another 10 minutes, or do we want to finish this and record it and share it to you that way? Okay, fantastic. So for anybody, I want to respect your time. For anybody that has to go because of schedule commitments, thank you so incredibly much for being here. For those of you that are able to hang in with us, please, thank you so much for staying on. If anybody does have to go, this will be recorded and you can watch the replay, but I'm hoping you can hang in a little bit longer. So we keep talking about small amounts. Again, it's not climbing Mount Everest by like jumping up to it, right? It's small amounts over time is what makes a big difference. And this is how money grows money. So let's take the example of $6.60 a day. $6.60 a day invested in an account that's going to give you about 10% annual return. And we'll talk about where some of those places are. Over a 30-year period of time is almost $500,000. That's almost $500,000, right? Imagine having that in your IRA account. Imagine having that in your retirement account. Those amounts become really, really big. How does that work? Well, it's really important for us to know how money compounds. So there's two, if you don't take away anything from today, I want you to know, like, cash indemnity. I want you to know how much of what you make is yours to keep. And I want you to know about compound interest. So there's 2 different types of interest that we're going to be talking about. First is simple interest, and then it's compound interest. Simple interest is basically, look at this with the $10,000 example. Simple interest will always earn interest on the initial base amount. So in the example of $10,000, I'm going to have a return of 4% a year. I'm going to have $400 credited to my account every single year. So my account balance will go up by $400. Done. Simple, clear, simple. Now, why does compound interest make money grow money? Because look what happens here. So the first year, yes, it's going to grow 4%. That gives me $400. Year 2, that 4% is going to grow on $10,400. So just by year 2, I'm already ahead. I'm at $10,816. Year 3, I'm going to grow that 4% on $10,816. Year 4, I'm going to grow that 4% on $11,248. So when you look at a 30-year range, simple interest is going to give me $22,000. Compound interest is going to give me $32,000, $10,000 more, right? So knowing what questions to ask before you make an investment. Things like a traditional bond, like a treasury bond, a lot of times will give you simple interest. Things like CD accounts, a lot of times will give you simple interest. Anything with mutual funds, your IRAs, Roth IRAs, the index strategies, those kinds of things will be compounding. If you aren't sure, the question that you ask the person that's helping you, the financial professional, is just want to make sure, is this going to be compounding? Yes, it is. Fantastic. Or actually, no, it's not. And then you can say, okay, well, do I choose to do this or do I choose to do that? Again, knowledge is that potential power. What questions do you have on this? Now, let me ask you a question. Remember when we talked about debt? So this is 4%. You see what $10,000 turns into with a 4%. Now imagine that being 26%. Do you see how quickly that interest compounds and grows on itself? And that's why credit card companies make so much money off of us. The other, again, we talk about the earlier you have to start, the better off you are. This is two examples of, somebody started at 25 and they were contributing $3,600 a year or $300 a month. They contribute a total of $25,000. And when this person was 32, they were like, you know what, I'm good. I'm gonna buy a house. I'm gonna have all sorts of different expenses. Yes, I will. Kim, very good question. One sec, I will answer it. I'm gonna stop contributing. I'm gonna put my money elsewhere. That $25,000 is just gonna sit for me and grow. Me, that's my friend. I was like, you know what? I'm actually going to start at 32. Now I'm kind of in a place where I feel better. I'm going to invest, whether monthly or annually, and I'm going to catch up to you. So I'm also going to do $3,600 a year. It would have taken me $61,000. And let's say it would have taken James, person number one, $25,000. Because James had a lot more time for his money to grow and compound, I contributed more than double than he did. And we netted out at around the same exact amount. So again, the earlier that you can start, do not wait for life to be perfect to start. Even if you're doing $50 a month, even if you're doing $100 a month, it is much better than waiting to do hundreds of dollars a month later. An excellent questions that Kim asked is dollar cost averaging a good strategy? What is dollar cost averaging? So when you have where you have investments, dollar cost averaging says invest small, consistent amounts of money over time consistently. What does that look like? Let's say you open a Roth IRA account and you're like, okay, I've got $5,000. I'm going to have $5,000. Do I contribute $5,000 and open my account now? Or do I spread that $5,000 over 12 months and make consistent monthly payments for that year to get to that $5,000? Dollar cost averaging is small, consistent, is spreading out that $5,000 month to month to month to month. Dollar cost averaging historically shows much greater returns. So it is actually an excellent strategy. It's like long and steady. Why it is a really good strategy is because you're not, the market does crazy things. If you imagine rolling the dice and you're going to throw the dice, and if it lands on a good number, congratulations, you're up. But if you put all your money in a month where the market isn't doing well, you're not guaranteed to capture like peak performance. And so when you spread it out time over time or month over month, you're actually averaging a much higher return than taking a guess on 1 month. So dollar cost averaging is an excellent way to go. Very good question, Kim. Do you recommend getting rid of credit cards? Will that affect your credit? Yeah. Depending on how many credit cards you have, right? Depending on how many credit cards you have, if you get rid of credit cards that were open for longer than 12 months, sometimes certain things do ping your credit. So this is something you probably want to look at as a case-by-case basis. It's going to be like your debt to credit availability and depending on what your short-term goals are. I wouldn't cut up every single credit card after this class by any means, because that can actually ding your credit. It's not necessarily having lines of credit open. It's about what are the balances and how many things that you have going on. And the other question, okay, good. The other question, this is like a 3 a.m. If I wake you up at 3 a.m. ever, not that I'm ever planning to, one of the things that I want you to know is the rule of 72. The rule of 72 basically means how long will it take my investment to double? This is how you very quickly calculate compounding interest and how you can impress your CPA and friends at parties when they're talking about different investment strategies. The number 72 always stays the same. So 72 divided by the interest that you're earning. So let's say in the case of this, it's 6%. So let's say I've got $10,000. I'm going to put it in an account that's going to give me a return of 6%. How long is that going to take for me for that $10,000 to become $20,000? I take 72, I divide it by 6, and the answer is 12 years. So in 12 years, that amount will become $20,000. That rule of 72 is really good for you to know at any time when you're talking about a mortgage payment. How long am I going to say is it going to take to pay it off, and when am I paying that company back twice? You can use it in that regard. You can also use it in regard to, okay, well, if I keep all my money in a CD at my bank and they're going to give me 1%, okay, so it's actually going to take me 72 years to double my money. Is that true? Yes, it's absolutely true. So it's a quick tip sheet, or it's a quick little mental sheet of how do you calculate like where your money is going and how it's working for you. Any questions on this? Time is money. We say time is money. What that means for us in the salon is very different than what it means from an investment standpoint. What it means from an investment standpoint is, again, the longer that you can invest is almost more important than how much you invest. What are some of the questions? And this is something that you're looking at right now. What are some of the questions before making any sort of an investment? You want to ask, what is the rate of return? That seems like a silly thing, but you have to know, and they have to be clear with you of what is the rate of return? What is my intention for this investment? If you're looking to buy a house in the next 3 years, you do not want to put all your money in a place where you're not going to be able to pull it out without a penalty, right? That's something that's long-term. And there are different investment products where you can put your money. So what is my intention for this investment? Does this investment type provide growth? Does it provide safety? Does it provide tax advantages? And does it provide any sort of protection? So things like cash value in life insurance will give you protection. If you're looking at putting all of your money in the stock market, it's not going to provide you safety. It's going to provide you lots of growth, but it's not going to provide you safety because you're at risk of losing things depending on what the market does. So looking at what is your personal, what are the things that are really important to you? And asking these questions will then lead itself to better conversations. What I will also say, I think I said it at the beginning, is every single time I've gone to talk to a financial professional or financial advisor, I've always felt less intelligent and more confused than when I went in. Do not let anybody take your power away from you. So know what questions to ask. The smartest person in the room isn't the one with the most information. It's the one who knows how to ask the right questions. So again, some of the key ones is, what is this going to do for me? Is it going to give me protection? What is my rate of return? What are the tax advantages to this product? And have them explain it to you. Do not ever, ever, ever let anybody make you feel less than what you are. So I keep talking about lots of different things, lots of different returns, 10%, 4%. What are the historical performances? When you look at CDs or certificates of deposit, typically speaking, these give us an average return of about 1.2%. Savings accounts in the bank, you see this, less than 0.5%. Mutual funds, which is basically an investment pool. What mutual funds is an investment pool, and they buy a little bit of shares, they buy some bonds, they buy some, different categories of investments, right? And all of the money is pooled. Mutual funds, those are typically about a 9.2% return. Typically, if you have a 401k, it's actually through mutual funds. 401k, here you go, is 8%. And the S&P 500, right? The S&P 500 stands for Standard and Poor's. I don't know, no one's poor there, but it stands for Standard and Poor's 500 companies. Typically speaking, these are the Fortune 500. This is your Apples. This is your, your big, massive brands that make up this list. When you invested anything with the S&P 500, anything, if it's an index strategy, if you're following kind of that market, typically speaking, because it's a self-regulating list, if they're not doing well, they're out of that 500 list. Typically speaking, this gives higher and healthier returns. Any questions on this? And last but not least, it's important to know what our taxes do for our investments. So there's 3 things, 2 things specifically that I want you to know about as you leave here today is basically tax now, your savings account, CDs, anything that you make and you show on paper is going to be taxed now. Anything that's gross, anything that it grows, the whole amount is going to be taxed. Where it's important for us to know, especially when we're planning for the long term, are things like tax later or tax deferred, right? Which are things like 401ks, IRAs, fixed annuities, right? These guys are going to be taxed at a later time. So if I'm buying seeds from you, let's just say, and I'm going to plant them, Listen, do you want me to pay taxes on the seeds now? And you're going to say, no, you know what? I'm not sure what this is going to grow into. Let me go plant the seeds, see what grows, and then I'll pay you taxes on once I like start selling and reaping the harvest. Then it'll be easier for me to pay taxes. I'm going to say, great, fantastic. I get to have taxes on all of that growth later, right? So tax deferred accounts, you remember you're going to pay taxes on them later. Why they say Roth is king is the tax advantaged strategy, which basically means, same seed example, I'm like, no, I think I'm just going to pay taxes on the seeds now because I don't want to pay taxes on my larger harvest when that grows. So I'm going to pay you taxes on this little bundle of seeds, and then whatever grows is going to be mine tax-free in 20 years, 30 years, whatever you're actually going to be reaping the harvest. There's only a couple of places where this strategy is acceptable. There is the Roth IRA accounts with, again, a maximum contribution of $6,000. There are the 529 accounts, right, which is the municipal bonds, children college savings accounts. There are health savings accounts if you work for a company that provides health savings accounts. And there's the cash value in the life insurance policy. So those are the only places where your money, you're paying taxes on it now, it can continue to grow for you, and that abundance later can be tax-free. You guys, I'm not trying to have anybody evade taxes, but it's really important to know, what do we want our money to do for us long term? Any questions on this? And so lastly, again, we talked about the questions, is always think about the balance of growth, safety, tax advantages, and protection. And now you know what the tax advantages are as well. And then the 10 and 20 rule. So again, when it comes to protection, when our income, it needs to be protected, we want to look at our annual income times 10. And when we talk about planning for retirement, we want to look at 20 times our income. Now that we understand a bit more about how money grows and how we can plant those seeds, that 20 times doesn't feel as daunting, because it's not literally you're putting away 10% of your income under the pillow or in the bank and hoping that it grows to 10 or to 20 years our income. Start planting those seeds. If you need resources, I'm happy to recommend you to a group of incredible professionals that can help you with this. If you have somebody, my only request from you is, again, when you're talking to any sort of a financial professional, make sure that you are getting the information that you need. Do not let anybody talk to you in a different finance language where you're not going to understand it. It's time for us to take that power back. And, we take care of others, you guys. This is what we do every single time, every single day behind the chair. So it's really time to take care of you. Thank you so much for joining. Again, the Bumble team, thank you so much for having me. For everybody that stayed on past our time, thank you. I truly value and appreciate you. And Suzanne, I'll take it over from here. Thank you so much.
Thank you so much, Anna. I have 3 pages of notes first and foremost. So I am just so on a high right now. So just to recap for everyone, and thank you guys for staying on, ask the right questions. I think I was texting Kelly on the side. I have never felt more empowered with hearing about financial information and not feeling self-conscious about not knowing things. So thank you for making it so friendly and so approachable to actually, 1, allow everyone, myself included, to ask the questions, but 2, to feel comfortable in moving forward with consulting our financial advisors. I have my life insurance policy that I pulled out while she was speaking, and I have a list of notes because I'm like, oh my gosh, where was Anna when I was actually creating this policy? And so many gems, cash anemone, what your money is doing for you and how to keep it, interest, compound, simple versus compound. So many key nuggets. So what I want us to do in 10 seconds or less is I want everyone to pick one action item. What are you going to do with this information that you have right here? There were so many great things and takeaways and homework that we have to do, but what is one thing that you are going to set for yourself to do immediately? Mine is call my insurance provider to update my policy. That is mine. So I want all of us to just take 10 seconds and pick that one thing. Okay. And the next thing that I want to do is, Anna, you have been such a breath of fresh air for us here at Bumble, and everyone that's been on the line. So we would love to know more about you. If you could drop into the chat your website where we can follow you so that we can make sure that we can stay connected with you. You are now a part of our Bumble family. So we are so thrilled to have not just someone else join the Bumble family, but someone who is so incredibly skilled and gifted in this financial area, because let's face it, we all know what we know and there's always more to learn. And we just learned a hell of a lot of information. And so thank you so much for dropping those gems for us. What I'd love for you guys to do is to make sure that you definitely reach out to Anna. She's going to drop in her website information in the chat. And then the last thing that I would love for everyone to do is we have a Survey Monkey. For those of you who are still on, we really value feedback. And by the looks of the timing, people want more of this. So please take the time to click on that Survey Monkey and just let us know what you enjoyed. Fill out the questions, add in any comments, anything that you would love to hear. Kelly and I were already on the side chatting, like we need more of this. And selfishly, I want it too. So again, Anna, I just have to genuinely thank you for your brilliance. And kudos to you for taking this leap. After 20 years in this industry and doing such a service to everyone and sharing all of this insight that you've gathered over the last year. So we welcome you into the family and we cannot wait to hear from you more in the future.
Thank you so much.
And I want to also thank,
could you try again?
oh, that's my watch letting me know. And I also want to thank everyone for dialing in on their days off or wherever it is that you are. We can't wait to connect with you in the future. And please check out our BB broadcast. This will be replayed there and more information to come on the continuing of our wellness program. Thank you all so much and have a great day.
Thank you. Bye.
Thank you again, Anna.
Thank you. Bye, everyone.